what you're doing is extremely sophisticated and strategic because, again, you're combining infinite banking and velocity banking. And so you're now giving your dollar about 5 jobs instead of just one, right? You were already giving it about 2 or 3 jobs doing velocity banking, but now by putting it into the whole life policy and growing it with the guarantees and the dividends, and then using that to offset and pay down the interest rate inside of the line of credit, thereby unlocking more equity so that you can do more things with the equity. I mean, that's you're just moving the money in a circular motion in a way that is going to push down the daily balance, push down the cost of the money, also get you the benefit of the growth inside the policy. And so that's, for me, is a win-win.
What's going on, fellow wealth builders? I got Sebastien Boyer with me, aka the Approved Guy. Now, let me tell you something about Sebastien. Not only is he a master at business financing, but he's also incredible with debt elimination and velocity banking. He's got some out-of-the-box strategies, and I'm so excited to have him on board on this show today. So, Sebastien, let's just jump right into it. What exactly is velocity banking, and how does it work?
Awesome. Well, first, Charles, thank you for having me on the show. I'm honored to be a part of your show and your audience. So velocity banking really is a strategy of just speeding up how you pay off and eliminate debt by leveraging other debt, namely a line of credit. So if you're able to leverage a line of credit that has the right interest rate and the right features, you can use that line of credit to pay off and eliminate other debt. Think of it like you're self-consolidating, but instead of using a loan, you're using a line of credit. And because of the features of a line of credit, you're able to do some very powerful things there that help offset interest rates, reduce interest rates, and then helps you to pay off and eliminate debt faster. That otherwise, if you were just kind of doing the traditional debt snowball method, which is legitimate, but it's just a faster way. It speeds up that debt snowballing. And again, it's really based on a case by case circumstance, based on what you can get access to and what your debt is, and then comparing interest rates and functionality. So it's not a one size fits all type of a cookie cutter solution, but essentially that is what velocity banking is.
Interesting. So tell me, you brought up a key point. You said the line of credit has to have certain features. So what exact features are we looking for?
Sure. So first, again, like when we're practicing velocity banking, the very first thing you have to know is your 4 numbers. Your 4 numbers is going to be what's your income, okay? What are your monthly expenses that you can't get away from, like food, groceries, gas, the light bill. No matter what, you're never going to get rid of that. Those are ongoing expenses. And you have to separate that from your debt. And that's where most people make a mistake. They bundle all that together. But you want to separate your debt obligations, your credit card payments, car loans, student loans, your mortgage. These are debts that eventually can be paid off, right? So the first thing you want to do is know your 4 numbers, and then ultimately the last number is going to be your cash flow. So your income minus your expenses minus your debt obligations equals an amount, and then whatever's left over every month is your cash flow. Right. Gotcha. So that's what you either have that you're putting into an emergency fund, or you're maybe using extra cash flow to pay off debt a little faster, or maybe you're using that for a vacation fund, whatever it is. But that's that extra cash flow that most times, if you don't have a plan for your cash flow, it has a plan for you, and it gets spent. You don't even know where it went. Right. So we want to give and assign a job to every single dollar so that no dollar is going to claim a task or a duty that it wasn't supposed to claim, and therefore being inefficient. So that's where it starts, those 4 numbers. Now, when we know those numbers, we know what our interest rates are, we know what our terms are. So if we have a loan with an interest rate that's not attractive, it's upwards near above 5%, going up to 10. Of course, credit cards can go up into 15 and into the 20s, right? Yeah. Then we want to look at the highest interest rate card, and actually the most efficient way of determining what debts to pay off is a combination of which one will you pay off quickest in relation to the interest rate, and the amount of cash flow it's going to release. And that's called the cash flow index, right? And I can give you a link later that you can show the audience of how do you kind of create that priority, right? But bottom line is the index, the interest rate that's higher, okay?
Okay.
Let's say we have a 10% interest rate, just using that as a simple example, and we can get a line of credit that's going to be lower than that 10%, right? Then that's a no-brainer. Like I could just transfer that debt from the 10% to the 5% line of credit, no-brainer. I'm going to win, right? But that's not where velocity banking starts, because in some cases you may get the line of credit that's going to be equal. Maybe the debt is 5% and the line of credit is 5%.
Gotcha.
In some cases, you might get that line of credit where the interest rate's even a little higher. Okay. So let's say it's 6 or 7% and the debt is 5%, right? So logically on the surface, you look at that and say, well, that doesn't make sense. Why would I transfer a 5% debt to a 6 or 7% debt? I'm going to pay more interest, right? Problem is that certain debt is amortized. And with that amortized and then the compounding effect, you end up paying a lot more interest than what you see as what's declared as the annual percentage interest rate. So you end up paying a lot more over time. Where a line of credit is calculated daily. So this is what I was saying as far as the right features. The line of credit has to be a simple interest daily calculation that allows you to put extra payment into the line of credit, and it doesn't force that extra payment into the payment of the line of credit balance. So that means that that payment can sit in the line of credit. It gets treated as though it is a payment towards the balance. However, it's not actually a payment towards the balance. So therefore, it's still accessible, right? And that's also just a standard feature of a line of credit, is that if you do put a lump sum in, you can leverage it out again. Okay. So there's several types of lines of credit. There's a first lien HELOC, a second lien HELOC. HELOC is a home equity line of credit, right? There's a personal line of credit. There's a business line of credit. And then you could also use a high cash value line of credit, leveraging a whole life insurance policy, high cash value loan, or a line of credit from a third party as part of your velocity banking strategy. So these are your lines of credit. You could also use a credit card, but you have to be very careful with the limitations of when and what you can do with those cards, as well as expiration dates on any types of promotions. So ultimately, it's a lot of moving parts, and you have to again look at a case by case. But let's just say we did get a simple interest daily calculated line of credit, whether it's a personal line, business line, or a HELOC. So now I'm going to be taking a lump sum from that line of credit. So that's the next feature, is the amount of the line of credit has to be large enough so that I can borrow against it. I can leverage that line of credit, and I don't want to touch more than 60% of that line of credit. That's just a very safe place to be. Okay. Maximum is 80%. Right now, could you do more? Yes. Will people do more yet? Will they have success doing more? Yes. It's just, if I'm coaching someone, I want to teach you to be more conservative, overestimate expenses and underestimate cash flow, right? And always leverage debt conservatively, so you're not maxing out the debt, whether it's a credit card or a line of credit. So a higher range of utilization would be 60 to 80%. And we're trying to stay somewhere around 60 to 65 in terms of a lump sum chunk. So if I have a debt that's, let's say, 150,000 at 5% interest, okay, and I have this line of credit that's at 6 or 7% interest, and I have $200,000 on that line of credit, okay, and I can tap into 60% of that. What's that? About 120,000, right? So I could take that 120,000 in one lump sum, hit that $150,000 debt, right? Transfer that debt from that amortized schedule on that loan that's at 5%, and move it over to a simple interest daily calculation at a higher interest rate. But the reason it makes sense is because now what I'm going to do is I'm going to take my income and I'm going to let it sit. I'm going to transfer my income every time I get paid and my cash flow, and I'm going to let it sit in the line of credit. By doing
Gotcha.
that, when they calculate the interest rate, they're doing a daily calculation based on the actual balance and limit. And because they treat that income in the line of credit as a payment towards the balance, they're calculating the interest at a much lower balance. Therefore, my interest calculation is lower and I end up paying less interest indirectly.
Gotcha. Now,
So now, go ahead.
you brought up a key point where if you're going to do this strategy, what you want to do is you want to start driving all that cash flow into that line of credit,
Correct.
right? So you drive the balance down quicker, and because you're now utilizing simple interest over the amortized interest, it becomes more efficient over time, and it's kind of like a snowball effect, because as you pay down that that line of credit, it just increases faster and faster and faster and faster, where you're paying that debt quicker and quicker and
Correct.
quicker. Is that correct in my assessment of that?
It is correct. One thing I made a mistake of once, and I got someone, kind of attacked me, and is I made the mistake of saying that the amortized interest. So the correct thing to correct that, just so that somebody who's going to nitpick and try to pick us apart,
Gotcha.
is that all interest is simple interest. It's just the
Okay.
schedule of how that interest is paid.
Gotcha.
On certain debt, like a mortgage, it's amortized, right? It's
Okay.
still simple, but it's an amortized schedule.
Okay.
The interest on the line of credit is a daily calculation. So the calculation is daily based on the interest and the balance. And as a result, that is what makes the difference in terms of the feature or the functionality of the line of credit. And by putting your income in that line of credit, now what else happens is that line of credit is revolving. So as you're paying back that line of credit, it becomes available, and your goal is to do it again as quickly as possible. So you might chunk only once or twice a year, depending on how much debt you have, meaning transferring a lump sum from the line of credit to the debt that you're trying to pay off, right?
Gotcha. Gotcha.
But your goal, once you do that lump sum chunk, is to let your income sit in the line of credit for as many days of the month as you can, right? So that those
Okay.
calculations on that simple interest are being calculated at a lower balance. Therefore, you're paying a lower interest. And then you're paying back that line of credit as quickly as possible so that you can leverage it again to eliminate any remaining debt.
Beautiful. So tell me, Sebastien, who is this strategy for? Because I know this isn't for everybody, but it's definitely a powerful strategy. So who is it for?
Sure. Yeah. So first, I'm going to say it's going to be for you if you're, number one, sick and tired of paying off debt slowly and you want to speed up the process. It's not for you if you're just kind of figuring out that you need to get a hold of your debt, right? What I would recommend for that person, you still need to start with your 4 numbers, but I would probably recommend, let's start debt snowballing first, right? Let's just start, with the basic principles of being a good steward with our cash flow, right? Let's start with identifying where you're overspending. Where can we cut back on expenses? Where can we cancel unnecessary monthly automatic payments? Reduce unexpected expenses. Just be more efficient, right? And then create your buckets of where your money is going to go. Your saving bucket, your giving bucket, right? Just start with the basic principles. Experience that for a few months. That snowball for just a couple months until you get in that position. You probably, if you're in a bad case where you have bad debt, chances are you probably also have bad credit. And so if you have bad credit, it's going to be difficult, if not impossible, to get the line of credit that you would need to start practicing velocity banking anyways. So you probably you might need to start first with just the basic financial stewardship of debt elimination, these basic principles. Work on improving your personal credit, improving cash flow, efficiency. And then you've kind of trained yourself over 6 months or so, gotten yourself into position, and now you might be ready to use a line of credit to start practicing velocity to speed up the process, right? So that's kind of for someone who has bad debt and has bad credit and has never really started or looked at, themselves in terms of efficiency and being a good steward, it's not for you, not yet.
Gotcha.
You can get there, but you don't want to jump into velocity banking because it sounds good and exciting, but you've never really actually done a good job of managing, just making your monthly payments on time, right? So so now who would it be for? It would be great if you are someone who is disciplined. You're managing your debts and responsibilities very well, right? You just have a large amount of debt or higher rates that you want to pay off faster, and you have access based on your credit and your history. You can get access to the right line of credit. The ideal line of credit would be a first lien HELOC. That would be the ideal line of credit. And I can elaborate on that versus a second lien HELOC if you'd like, but that would be the ideal line of credit. But again, to get there, you'd have to have been a good steward. You'd have to have had good payment history. You have to have cash flow because you're basically qualifying for a mortgage to be able to get that first lien HELOC. So yeah, that would be the ideal person. And then of course, if you're a business owner or an entrepreneur and you also fit in that bucket of a responsible, disciplined steward of your resources, then you can leverage the strategy in your business as well. So either on the personal side or on the business side.
So like you said, it's a case by case basis, right? And everybody's situation is different. But basically what I understand is what you said is if you're already a good steward of your money, this would be probably a good strategy to implement, but it might not happen overnight. It's something that, it's going to take a transition to actually achieve this. It's not like a light switch where you just turn this on or off. And then if you're not a good steward of money, if you're not, if you haven't established the habits of paying bills on time, I think my biggest takeaway from you is figure out how you can build those habits of being a good steward of your money. Establish those habits first before you jump into this strategy. Because if you were to jump into the strategy and not have the habits, one, you probably wouldn't even be able to get the line of credit. But two, if you did have the line of credit, there's a good chance that this would damage and hurt you even more than if you didn't implement the strategy altogether. Is that kind of a good takeaway?
Correct. Yes. There's just a lot of moving parts. So being disciplined and being, committed are two extremely important elements to your personality and character to be able to properly and to successfully.
Gotcha. And full disclosure, I'm actually a practitioner of velocity banking and cash flow banking, or the infinite banking concept. We'll dive into that a little bit later. And so what I'm doing is I have a rental property in Alabama and it has an all-in-one loan. So my cash flow goes into that loan and I pay it down as quick as possible. And in the future, and as I do that, my cash flow increases, right? Because I'm paying down that principal quicker and quicker and quicker. So it's kind of like a debt snowball in like a different sense. But can you elaborate on what exactly is an all-in-one loan and why would you prefer a first lien HELOC over a second lien HELOC?
Certainly. So we'll start with what is a HELOC and what's the conventional, traditional, what everyone's familiar with, which is a second lien HELOC. So a HELOC is a home equity line of credit. And typically you're accessing a home equity line of credit after you've paid into your mortgage over several years, sometimes 5, 10, 15 years before you have paid off enough of the loan, and that now becomes equity that you can access, right? Now, in a mortgage, that equity is trapped in the loan. It's trapped in the walls of your house, of the property, right? You can't just get access to it. And so if you have good credit and you're qualified, you can then apply for a home equity line of credit where they take just that portion. So let's use 300,000 as an example. You've paid in 150,000 over the last 10 or 15 years. So now you have $150,000 of equity. So you're applying for a home equity line of credit on that 150,000, which they would give you a second lien. So your mortgage remains intact with a first lien on that mortgage. And then they give you the HELOC home equity line of credit as a second lien, second position. Okay. Now that HELOC is by itself its own instrument, and the mortgage is its own instrument. So they're two separate instruments. They don't talk to each other, right? So you now have your ongoing mortgage payments, and you have your ongoing HELOC line of credit functionality that you can leverage. A lot of time historically, people have used this to do home improvement, to maybe just get access to that liquidity for maybe some investments, or for cool kids' college tuition. There's you can use it however you want, but what Velocity Banking says is we're going to use that HELOC to pay off the rest of that mortgage faster, to transfer that balance from the mortgage over to the HELOC as quickly as we can, or other debt, depending on your priority in terms of the order of debts that you want to pay off. But you're going to use that HELOC to do that. Okay. Now, the second lien HELOC, it takes a little extra steps, because you have to transfer money from your checking or savings account into the HELOC, right? To put money into the HELOC for it to sit there. You have to monitor when you need to pay bills, depending on the HELOC and the bank that you work with, they might give you a checkbook to write from the HELOC. But if they don't,
Gotcha.
then you have to transfer money from the HELOC back to your checking to make payments. So again, it takes more commitment and responsibility, because now you have to have everything timed as far as the days that payments are due, the day that you want to transfer and pay for your lump sum payoff to other debts.
Okay.
Everything has to be set up properly in advance. You're probably going to spend a month or two just planning, preparing to put this into play so that everything goes smoothly, right? And you need to have already vetted the instrument, the HELOC, and the features and how it works. How long will it take for money to be transferred from this account to that account? How long will it take for me to deposit money in that account and for it to show available? Because if you start practicing the strategy and you haven't prepared with all these details, you might start hitting stumbling blocks that trip you up and get frustrated, and a lot of people just give up, right? So
Gotcha.
preparation is crucial. But the second lien HELOC is a second lien, and the mortgage stays on the first. The balance of the mortgage stays on the first. Income goes into the HELOC. HELOC pays the debt off. Income pays down the HELOC, and then you have to move money in and out of the HELOC. Now, one of the risks of a second lien HELOC is that banks have at their discretion the ability to reduce the balance on a HELOC, or to even close a HELOC altogether, right? And that's one of the reasons why we teach conservative utilization. We don't want to max out that HELOC. We want to keep it utilization at 60 to 80%. You don't want to throw up any red flags where the bank that's issued that HELOC is looking and seeing, wow, they just got a $150,000 HELOC and it's at $149,000 balance, and they keeping it at this high balance for this period, length of time. Will you have trouble with that? Maybe, maybe not, right? But
yeah,
we want to try to be safe and do everything we can to stay in the grace of the bank, because they do have the authority, if they needed or wanted to reduce the HELOC, or to freeze it, or to close it down completely. And then what happens is that HELOC turns into a loan, if that were to happen. Okay. Now, that's a second lien HELOC. Okay. So it works. It's a little bit riskier. It takes a lot more responsibility, a lot more timing, a lot more pre-game work to really be ready for that. A first lien HELOC, which is what you said, the all-in-one loan, is it replaces the mortgage. So now the same scenario where we have a $300,000 mortgage with a $150,000 balance, that entire $300,000 note is going to be refinanced into a first lien or first position HELOC, right? So now that $150,000 of equity is available, just as it would be in a second lien HELOC. Okay. And that $150,000 balance is now just a balance on the HELOC. So now, as I make monthly payments into the HELOC or into the balance of my HELOC or my mortgage, that same day, it transfers that equity. If I made $1,000 payment, that $1,000 that same day becomes available on the line of credit So the next day I have access. So now what it's doing is it's turning my mortgage into an instrument that it becomes liquid and accessible for me to start using to do whatever I need to do. Right. So now I don't need to
Gotcha.
worry about chunk payments or anything. I don't have to do that anymore because I've already done it. I've refinanced the whole debt into that line of credit. But that's if we're only concerned about a mortgage. Maybe I have student loans. So I'm going to chunk 30, 50,000 to my student loans, right? Or
Okay.
maybe I have a car loan or some other debt that is higher interest, amortizing, and I want to get rid of it, credit card debt, right? Whatever the case may be. But as far as the mortgage is concerned, I've simplified my life because this first lien HELOC also has a checking account that's attached to it, but it's separate. And so now instead of putting my money in my previous checking account and having to worry about transferring it to the second lien and transferring it back and verifying the dates and all those little details, I still want to know that stuff no matter what. But
Yeah.
now I have a lot more, it's a lot easier because I'm just going to put my money in this checking account, and the first lien HELOC has a lot more protection because essentially it is my mortgage now. They can't just close it, right? So
Gotcha.
that's not going to happen. Number two.
Okay.
And when the money that I put in that checking account, I don't need to transfer it to the HELOC. Every single day, what they do is they look at how much money do you have in your checking account, and they do what's called a daily sweep, and they treat that amount that's sitting in your checking account as if you made a payment into the HELOC. So the same thing that we talked about having before happened with a second lien HELOC is happening, but without having to actually put the money into the HELOC. It's being done because it's an all-in-one. It's a HELOC that is a mortgage and a checking account all together, all in one.
It's interesting, and it's a little hard to wrap your mind around that whole concept. And it's funny because when I was getting approved for the house and for the mortgage and everything, like the seller agent, they just didn't understand what was going on. They just didn't understand the concept, and I had to like walk it through. Like, this is what it is. I sent them the website of CMG, who most of the all-in-one loans are written through. And it was a little frustrating to convey that concept. Now, right now, we're currently we have an uptick of interest rates, right?
Yeah.
And there's a lot of people with lower interest rate mortgages. Okay. So, Sebastien, tell me, when would this strategy make sense for those people to maybe trade in their lower interest rate mortgage for this higher interest rate all-in-one loan? Like, is there like a certain threshold that would actually make sense in today's environment?
Yeah. So what I say to that is we have to run the numbers. We have to run the numbers because the amount of income and cash flow that you have is going to make a big difference on that. Because you could technically, if you work this strategy properly, you could pay down. You could end up paying between 0 to 1% interest with a first lien HELOC or with the velocity banking strategy, depending on how much income and cash flow you have pushing down that average daily balance, right?
Gotcha.
But not everyone has the same variables. One thing that's beautiful about the all-in-one loan CMG home loans is that they have a calculator that you put all your data in there and it runs it, and it shows you, okay, if you keep doing things the way you're doing it now, you're going to have this result, or if you do it this way, you're going to have this result. And I've referred folks to them who, just for a conversation, who came back and told me that I should probably wait until the interest rates change or until I've paid off more equity, so I have more access to more equity. They're not looking to just stuff people into this product. They're looking to make sure that it makes sense, and that they understand it and that they're going to leverage it. Right now, the only time I would say that even if the interest rate is higher and you're not going to be able to pay it down to a lower rate using the velocity banking strategy is if your objective is really to just get access to the equity. Because now if you can access that equity and invest it in your business or invest it in something that's going to give you huge returns, well, that's going to be an advantage, because now you're leveraging it not just for the debt elimination, but for the potential investment opportunities that cash flow can give you. Now you're tapping into the HELOC, first lien or second lien, not just for the debt elimination benefits of velocity banking, but because you're going to be leveraging that equity. So, then you have more than one reason now to implement the strategy. But ultimately, when you leverage that debt, you want to continue to manage it with the same principles. So that's the other thing that people have to look at, is that you're unlocking equity, right? And again, you have to know yourself. You have to know that if all of a sudden I have access to all this money, am I going to be a good steward with that? Am I going to be responsible, or am I going to end up, taking an unknown amount of vacations and, end up in Las Vegas somewhere, just putting myself in jeopardy, right?
Gotcha. So one of the things when you're utilizing the all-in-one loan is that every month your interest rate can get adjusted, right? So when interest rates lower, your interest rate goes lower. But when interest rates rise, your rates increase and the cost of that debt increases. So one of the strategies, and I'd like for you to elaborate on this, Sebastien, and see what your take is. But one of the strategies that I'm utilizing is what I'm doing is I'm buying whole life, high cash value life insurance policies, and I'm putting money into that. And then the cash value that I create from that, I dump back into the all-in-one loan. And so essentially what I'm doing is the life insurance company is now carrying my mortgage at a lower interest rate. But at the same time that they're carrying my mortgage at a lower interest rate, that money is growing uninterrupted compound interest because of the way that it's designed with the certain insurance companies that we utilize. So Sebastien, kind of elaborate how that exactly works and when it makes sense for somebody to utilize that strategy.
Yeah, beautiful. So I call that strategy infinite velocity, because now you're combining the velocity banking strategy and the infinite banking strategy, and you're marrying these two strategies together. And so first, I guess, to talk about the infinite banking, and just to clarify that, I know your audience knows, but obviously we're using a whole life insurance policy with a major mutual company, dividend sharing carrier, and we can design the policy where we're putting anywhere between 75 to 90% of the premium going towards the cash value bucket. And if it's set up properly, it can have uninterrupted compound interest growth. We have guarantees and we have dividends. And then we have the ability to borrow against the policy. Just like equity, think of it like, okay, your policy has equity, you're going to borrow against that equity, and you can now leverage that in whatever you want to do with it, right? So one of the reasons they call it infinite banking is you can do infinite things with it. You can use it to pay off kids' school loans, or to pay for a new car, or your business, or invest in the market, or to pay off your mortgage and eliminate debt. And so what you're doing is extremely sophisticated and strategic, because again, you're combining infinite banking and velocity banking. And so you're now giving your dollar about 5 jobs instead of just one, right? You were already giving it about 2 or 3 jobs doing velocity banking, but now by putting it into the whole life policy and growing it with the guarantees and the dividends, and then using that to offset and pay down the interest rate inside of the line of credit, thereby unlocking more equity so that you can do more things with the equity. I mean, you're just moving the money in a circular motion in a way that is going to push down the daily balance, push down the cost of the money, also get you the benefit of the growth inside the policy. And so that's, for me, is a win-win. That's the best way to do it. Some people will say, "Oh no, you shouldn't do a policy until you just pay off all your debt." I disagree with that because of the opportunity cost. And even if you just start with something small, at least you lock it in, and you can, maybe do a larger policy later. But there's no guarantee that tomorrow you're not going to slip on a banana peel and, break your back, and now you're not insurable, or worst case, you die. And now you didn't put a policy into play. So for me, the urgency of putting a policy into play is extremely urgent. And if you can implement that policy along with your velocity banking strategy, then in the long run, you're going to come out on top. It's going to be a win-win for you. You're going to eliminate the debt efficiently, and you're going to grow compound interest. That's going to be a huge potential emergency fund and opportunity fund inside of your life insurance policy, which could also become a retirement supplement fund as well. So that's something that the longer you wait to start is the more expensive it gets, the less chance of you being insurable. And so I urge my clients, when I speak to them, to really consider that option and putting it into their velocity banking debt elimination strategy.
100%. And one of the perspectives and the way that I look at it is when you're transferring money from your all-in-one loan into the insurance provider, the life insurance provider, and then having the life insurance companies hold your loan, I feel like you're reducing risk, because you're reducing the risk that your interest rate is going to increase, because the interest rate fluctuates a lot more within your all-in-one loan compared to the mutually owned participating whole life company, where it can move, but there's a cap to it, and it's less likely to move up and down. And the flip side, let's say that interest rates dive and that life insurance policy is more expensive. Well, then you can just carry and pay that loan off as your all-in-one loan, just shift the money around, like you're saying, and then reduce your exposure to that interest rate. So it really, in my eyes, it gives you more flexibility overall. But Sebastien, so you've got, a couple really cool master classes out there that I want to talk about. You have one that walks people through, like, from A to Z, how to start a business, right? And then, and just so that everybody knows, that's actually going to be in the link down below, so you'll have access to that. And be sure to take a look at that and strongly consider signing up for this class. But you also have a business credit mastermind, right? Masterclass where you really talk about how to start this whole process with the velocity banking, and how to get credit, how to get money from institutions. And you could actually pair the two masterclasses, where you could start your business and get the funding with the business credit masterclass that you have together. Can you just expand a little bit on those two things?
Sure, certainly. So on my channel, I teach personal credit and business credit and business financing. When I'm working with a client, I look at, not everyone has the same ambitions in terms of being an entrepreneur, right? Some folks are happy with their job and they really just want to retire. Maybe they're only interested in something more passive, but they're not ambitious to start a business, and that's okay. We're not all built the same. We don't all have the same gifts and talents or ambitions. But for those of you who are entrepreneurial, who want to start a business, one of the things in over 12 years of helping folks get access to loans and financing, when I'm speaking to a lot of startups who haven't formed their company yet, one of the biggest, daunting tasks in their mind is just getting started, is just literally getting the company. And I'm not talking about the formation, but they're concerned about missing a step. Like, what am I supposed to do? Like, where do I start? Where do I go? So I recently launched a course called Startup Secret Steps to Success, which addresses that. And it has inside the course step-by-step action steps. So it's not like a lot of fluff of talking, but more, step one, do this, do that, do this. But everyone is going to do different things depending on what they need or want to do. So, for example, if you don't need to patent a product, then you'll skip that, right? That section, but that's there. And maybe sometime down the road, you develop something you want to patent, you go back to your course, you have access to the instructions, whether it's going to be something you do yourself through the government portals or you hire a firm to do it for you. The course has those resources and it points you in the right direction. But it also explains to you the basic understanding of patents and things of that. That's just one part of it. There's, so many different steps in starting a business, from the company phone number, address, the name of the company, whether you're going to make it an LLC or an S Corp or a C Corp. And, if you don't know this stuff, if you've never been through it, you've never done this, again, it's overwhelming. And so a lot of people don't take action because of fear, because they're scared they're going to do the wrong thing. So the course just gives you the education to understand all these different things, and then gives you the tools and resources to get there. Now, prior to this, I had this course, Business Credit 101, for about 5 years now, where on that course, I teach you how to establish and build your business credit on your EIN with Dun & Bradstreet, Experian, and Equifax Business Credit Division. One of the first things you have to do in establishing your business credit is called your business's credibility, which includes the basic structure of the business, including the name, your SIC code, industry code with the government, just having the basic things, your phone number, address, your domain name, your email account, little things that a lot of startups, and usually when it's a startup like mom and pop, we skip these steps because we don't think they matter. And the truth is, not having a business phone number or a business email at your domain name, right, is not going to stop you from making money. You can set up an account with Gmail, right, and go launch your business and start making money. That's not going to stop you from generating revenue in the business. But when you want to go and apply for a loan or a line of credit, it's also not going to decline you, but it's not necessarily going to make you look as attractive or as serious as the entrepreneur who has an email at their domain name, who has a legitimate business address, who knows what their industry code is, and has their business name set up so that there's no conflict, depending on the industry, right? So there's a lot of little variables that can determine whether you get approved or declined, or if you get approved but you don't get the best rates or terms because of these little variables. And then in due time, you want to eventually build up enough business credit so you can start getting approved for funding in the business name without any personal guarantee whenever you can and wherever you can. And so that's the business credit course. So what I've done is, in my Startup Secret course, I added that basic credibility as part of it. And so you end up actually paying the same for the Startup Secret course as you would for the business credit intro section, right? And then there's an option in the Startup Secret to level up to the business credit. So if you do want to proceed and continue building your business credit even more, where you can eventually get to the point of buying a car or assets like computers in your business name with no personal guarantee, where you could finance that vehicle with no personal guarantee, 100% business asset, then you can do that. But the minimum business credibility doesn't accomplish that. But that does accomplish is it makes you a legitimate, credible business in the eyes of banks, lenders, and credit bureaus, so that when you do qualify, you can get better rates, better terms, bigger approvals, and it's just going to open up the door for more funding opportunities. So that's just part of the Startup Secret Step to Success course. My Business Credit 101 course is still available, but I would say that would be more for an established existing business who doesn't need to start from the Startup Secrets. They already have their patents, they already have their copyrights, they already have their attorney and their CPA. They already have a well-tuned business with all of the resources that make that business run. So that's Startup Secret Steps to Startup Secret Steps to Success course is really for your first time, maybe second time entrepreneur starting something, and they really need that guidance. But it's going to lead them into the business credit. It is going to teach them about velocity banking, because that's a module in the course. It is also going to teach them about infinite banking. That's a module in the course. And it eventually leads them to start thinking about succession planning, estate planning, and asset protection, which is maybe light years away for some people. But for some people, I believe by thinking about the end in mind, you're going to achieve that goal. If you know what you're aiming for, you can achieve it. But if you're kind of just running blind, you might get there, but it's going to be a lot, more difficult path to get there. So that's what the Startup Secret Steps to Success course does. And then the Business Credit 101, which is a level up, is available if you want to take the business to the next level in terms of the business credit and getting access to funding and assets with no personal guarantee.
Gotcha. I mean, this is such powerful stuff, guys. I hope anybody watching this looking to level up strongly considers signing up for these masterclasses, because they will take your business to the next level, undoubtedly. And I just want to express my gratitude to you, Sebastien, for taking the time out of your day to hop on this call. Can you tell us how people can get a hold of you and how people can work with you on a one-on-one basis?
Yeah, thank you, Charles. So my main website is theapprovedguy.com. That's my channel. It's at the Approved Guy. And on my website, there's a free consult for 15 minutes. We start there. But I am going to provide you a link for even a scheduled call where I can track that's your referral. So if you're watching this video, please use that link, which will be in the description of this video, if you want to schedule a free consult with me. But otherwise, you could just go to my website and do it there. But I always want to make sure I say thank you and give credit where credit is due. And so please use Charles' link.
Beautiful. Well, thank you, Sebastien. Everybody watching this, highly recommend you follow his channel, The Approved Guy, on YouTube. He's got unlimited awesome content. But anyways, until next time, see you, everybody.